Buddy, welcome back to another video here on Financial Friends. Today, we are going to be discussing the Federal Reserve, the rate hike, the potential recession or maybe not recession, depending on who you're listening to, as well as company earnings and why we are continuing to see inflation, but could potentially see those prices stop increasing at some point. If any of this interests you, go ahead and definitely stick around. Hit the like button as well to help push this video to more people. Hit subscribe if you are not already. Financial Friends is a community of people who love business, finance, and investing. So you joining the community and leaving your thoughts down below in the comments is always appreciated. We are on the road to 1,000 subscribers, so definitely consider subscribing. That way we can hit that goal by the end of this year. And without further ado, a disclaimer before we get into this video. I am not a professional. I am not an investment advisor. I am not an economist. I am here to give you some of the information that I am taking in, but I also want to make it known. There is a lot going on in the world. Sensational headlines, political agendas, everything under the sun that could be trying to distract you from your long-term goal with investing is happening right now. Recession fears, rate increases, sensational headlines, constant push of company names, prices going up, earnings, yada yada, everything is crazy. I'm not an investment advisor. I personally am sticking to my long-term goal. Looking into sensational headlines, looking into things like this can give you the wrong idea that you need to change course all of a sudden. If the fundamentals of what you are doing has not changed because of the information that I'm about to say or any information that you read about, you shouldn't change what you're doing. Instead, you should be diligent and focused and consistent on your goal and not stray from it, because straying and changing left and right is a losing strategy. So, let's go ahead. We're going to discuss some of the topics here. Your comments and your commentary in the comments section is crucial. Leave your thoughts on this video as I go along. If you want to type along with me, go ahead and do so. Let's go ahead and dive into the topics. I have some sticky notes laid out in front of me, so I try and stay on topic. I've rambled off of topic many times already trying to record this video, so I'm going to be looking down at those to kind of stay on pace here. So, the Federal Reserve is 0.75% rate increase. Of course, that goal to drop consumer demand so we could see it come back into line with supply, so we can see inflation finally stop. Basically, Jerome Powell did tell us a lot and didn't tell us a lot at the same time. He did mention that in the future we could continue to see unusually large rate increases, but right after mentioning that, also mentioned we could continue to see those, or shouldn't continue, but can see those slow at some point. Still mentioning potential increases. So my guess is, and I think everybody else is assuming, we're going to see rate increases. The pace at which we see those, if they at any point decide to decrease those, nobody knows. They're not trying to give too much month-to-month guidance as they were, and actually they're allowing the pipeline of rate increases that they've already given to kind of build up and truly impact the economy. There is no meeting in August, instead it's in September, and they're going to allow the economy to work itself out until then and reevaluate. Now, there was some mention, and this is crucial for moving forward, kind of assuming that what they are doing is starting to work. They are seeing a little bit of slowdown in consumer demand, and they're also mentioning a little bit of slowdown, not a lot, but a little bit, in the labor market. Their goal is to keep a strong labor market while also bringing inflation back down to 2%, and so there's a very delicate balance that they are walking there. Now, moving forward to GDP, there was a ton of questions to Jerome Powell about what he thinks about a recession. He made it very clear prior to any numbers being released from this morning that he does not think the United States is in a recession, citing it doesn't make sense that the U.S. would be in a recession given that monthly payroll has recently been averaging 450,000 jobs. That's a payroll growth of 450,000 jobs, and that employers have added 2.7 million jobs in the first half. He says, I do not think the U.S. is currently in a recession, and the reason is there are just too many areas of the economy that are performing too well. Well, we got that number this morning, and it was a decrease of 0.9%, essentially putting us into a recession. Depending on who you listen to, though, of course. Now, this number I'm not going to read into too much because we have a ton of analysis on inflation and the inflation of prices moving forward later in this video. But what I do want to mention is, are we in a recession or not? CNBC, at least Jeff Cox, who wrote this article, doesn't really seem to think so because he said GDP fell 0.9% in the second quarter, the second straight decline, and a strong recession signal. The title or the thumbnail of my video said economy in recession. So which is it? Well, by definition, a recession can be, or I guess a popular definition, I should say, make that clear, 2 consecutive quarters of a decline in a country's gross domestic product. That constitutes a recession. Well, definition from NBER, or the National Bureau of Economic Research, says we need a decline in economic output, consumer demand, and employment. But we're also going to consider, says the NBR, non-farm payrolls, industrial production, retail sales, and a slew of other things as well. So, read everything, just like Jerome Powell said, with a grain of salt. And the reason for that is these numbers can be revised moving forward. If we're not seeing decline in jobs, are we really seeing a decline in the economy as a whole? Which a decline in the economy as a whole is a true recession. Politicians will tell you, of course, that we're not in a recession. Part of this is political agenda. They obviously want to get, reelected. Midterms are coming up. There's a lot of politics that goes into everything that happens in the world and the United States. But YouTubers, kind of myself, I guess, I'm incriminating myself a little here with my thumbnail, news outlets, they're all going to scream from the rooftops, recession, recession, recession. Take everything with a grain of salt. It's good words from Jerome Powell. Enough on the macro economy. Let's go ahead and dive in a little bit more to specific companies and some specific stocks as well. Walmart is a very broad signal of spending from the consumer. There are thousands of Walmart locations. Everyone has probably been into a Walmart that's watched this video, and well, as a result, there's some headwinds for Walmart. They are citing increased spend by consumers on food and fuel. I've mentioned this before on TikToks and other social medias, all linked down below, but spending more on food and fuel means there's less cash for you to spend on other things that they want you to spend money on, like electronics, toasters, discretionary other items, clothing, etc. Why? Well, those products, the discretionary spend products, have higher profit margins for the company. Walmart is a business. They're in business to profit, just like Target and just like Amazon, which we're also seeing the same exact headwinds on spend for discretionary items. Now, food and fuel increases are happening and have been happening. What happens with that? Less money from your pocket to be spent on other items. Now, why are we seeing these type of increases? Well, inputs for these big companies, Coca-Cola, Unilever, Kimberly-Clark, McDonald's, they are seeing increased input costs to produce these items, and as a result, they can either choose one of two things: absorb the cost of those price increases on their end and profit less, or pass the cost on to you, the consumer, who currently, they are saying, is still buying the product. So as a business, in business to profit, of course you're going to just raise the price because the consumer, including me and you, are going to pay for it. Diving into this Wall Street Journal article, the title here: don't expect big consumer brands to lower prices. Coca-Cola, Unilever, and Kimberly-Clark say price increases have helped them cover cost for inflation, but they're monitoring how we are spending. Exactly what I just said. So, their prices are going up. Executives say, we're going to continue to do this because you guys are still buying the stuff. Prices rose on Unilever's side 11.2%, or on Unilever's products, 11.2%. Kimberly-Clark, 9%. McDonald's and Chipotle say, hey, we see you guys out here. We understand you are trading down. buying value meals, not combo meals. But if you think of McDonald's and Chipotle's position in this economy or in the hierarchy of restaurants, they're sitting at the low end of the totem pole. And so they are seeing some consumers trade down, particularly in McDonald's. Okay, so you might not buy a Big Mac, you might buy quarter pounder. You're not going to buy, French fries, Big Mac, and a drink. You're just going to get the Big Mac. But either way, you're still purchasing from McDonald's menu, right? And if you were normally an Outback Steakhouse type of person, but you're now a Chipotle person, well, you're still buying their food. And if you were an Outback Steakhouse, Red Robin type of person, and now you're getting from McDonald's, well, they just added new customers. So they're seeing increased earnings, they're raising the price on you, and you're still paying it. And I'm not trying to say anything negative towards you, but the fact of the matter here is we're seeing continual increases in inflation, and this is why. If companies can pass on the cost to you and get beats like 2.8% or 2.84% for Chipotle, 3.39% for McDonald's, a 4.69% beat for Coca-Cola, a 4.97% beat for Mondelez, and a 7.1% beat for Pepsi, then they're going to do that. And so these continual rate increases are going to happen. It's going to take more cash from you, the consumer, because your credit card bill is going to go up as a result of an increased rate. You might not lend as much, meaning if you're not going to take out a loan, you're not going to gain an extra couple $1,000s from a personal loan. You're not going to have money to spend. And at some point, you will cease to buy Chipotle, McDonald's, your 12-pack of Coca-Cola, Wheat Thins, or your Pepsi. What happens then? Prices stop increasing because they need to continue to sell product. And if prices can't go up, they stay the same or go down, and inflation stops rising or actually comes to the downside. So it's really my summary right there. This is everything that is going on in the economy. There is a lot happening out there, and my final kind of point is don't be sensationalized, but know what's going on. It's important to understand how things are working. It's important to understand if your businesses or your stocks are doing well, if they are raising prices, or if they are taking on some of that cost. It's always good to stay informed. It is not good to continually change your mind and change your investment strategy. Remember to hit subscribe. Remember to hit the like button down below. Give me your thoughts down below in the comment section. Are we in a recession? Are we not in a recession? How are your companies faring in this inflationary and crazy time? Leave those comments down below. Hit subscribe, hit like, hit the bell so you're notified when a new video comes out. And I will see you all in the next one. Take care.